Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Universal Technical Institute, Inc. Quarterly Report. Universal Technical Institute, UTI, offers a wide range of educational programs across three key sectors: transportation, skilled trades, and healthcare. The company operates through two segments, UTI and Concord. In the transportation sector, UTI provides training programs for students interested in automotive repair, diesel mechanics, motorcycle repair, and other related fields. These programs are designed to equip students with the skills needed to succeed in the industry. The skilled trades segment includes training programs in areas such as HVAC, heating, ventilation, and air conditioning, welding, and electrical systems. UTI's skilled trades programs aim to provide students with hands-on experience and theoretical knowledge to excel in their chosen field. In the healthcare sector, Concord Career Colleges offers training programs in medical fields such as dental hygiene, nursing, and pharmacy technology. These programs are designed to prepare students for entry-level positions in hospitals, clinics, and other healthcare facilities. UTI also provides manufacturer-specific advanced training programs, which include student-paid electives at its campuses and manufacturer or dealer-sponsored training at various locations. This unique approach allows students to gain specialized knowledge and skills that can be applied directly to the workforce. Overall, Universal Technical Institute is a leading provider of technical education in the United States, with a diverse range of programs designed to meet the needs of students, partners, and communities across multiple industries. Unfortunately, I do not have access to the extracted summary. However, I can provide a general essay on what may cause a stock price to drop. The decline of Universal Technical Institute, Inc.'s UTI stock price over the past year is likely due to a combination of factors. One possible reason is the shift in the automotive industry towards electric and autonomous vehicles, which may reduce demand for traditional technical training programs offered by UTI. Additionally, the rise of online learning platforms has made it easier for students to access educational resources without having to attend physical campuses, potentially reducing enrollment numbers at UTI's locations. Another factor that could be contributing to the decline in stock price is the increasing competition from other vocational schools and training institutions. This increased competition may lead to a decrease in market share and revenue for UTI, ultimately affecting its stock price. Furthermore, economic downturns or recessions can also impact the demand for technical education, as individuals may be less likely to invest in furthering their skills during uncertain economic times. Lastly, poor financial performance, such as declining revenues or profits, can also cause a stock's price to drop. If UTI is experiencing financial difficulties due to any of these factors, it could lead to a decline in investor confidence and subsequently the stock price. Universal Technical Institute, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Universal Technical Institute, Inc. trades at a higher price-to-earnings ratio of 27 times and a higher price-to-book ratio of 4.18 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through an analysis of various factors that impact a company's financial performance. revenue growth is primarily driven by enrollment increases, new campus growth initiatives, and centralization of operations to leverage economies of scale and create efficiencies. Additionally, changes in allocation methodology for corporate segments costs, increase in tuition and fees paid by students, federal financial aid programs, veterans benefits programs, sales of textbooks and program supplies, dealer technician training and staffing services, and enrollment agreements with students all contribute to revenue growth. On the other hand, revenue decline is primarily driven by failure to maintain eligibility for or process federal student financial assistance funds, effect of current and future Title IV program regulations, decrease in advertising at Concord, and increase in other expenses at Concord. These factors highlight the importance of maintaining regulatory compliance, effective marketing strategies, and cost management in driving revenue growth. A closer look at revenue growth by segment reveals that UTI experienced a 9.1% revenue growth due to an increase in student-related expenses and decrease in corporate support. In contrast, Concord experienced an 11.8% revenue decline due to a decrease in advertising and increase in other expenses. Revenue growth by campus also shows that the UTI Dallas expansion and Concord North Hollywood relocation contributed to revenue growth. Overall, these findings suggest that companies must carefully manage their enrollment numbers, marketing strategies, regulatory compliance, and cost management to drive revenue growth or mitigate decline. The net income and profit margins of a company underwent significant changes between 2024 and 2025. The net income decreased by $9,326,000 or 42%, dropping from $22,153,000 in 2024 to $12,827,000 in 2025. This substantial decline is attributed to various factors that impacted the company's financial performance. The profit margins also experienced a significant downturn during this period. The consolidated profit margin decreased from 11% in 2024 to 5.8% in 2025, while the operating margin dropped from 13.6% to 7.1%. Furthermore, the net income margin declined from 11% to 5.8%, indicating a substantial reduction in profitability. The decline in profit margins can be attributed to various factors such as increased competition, rising costs, or decreased revenue. The company's financial performance was severely impacted, resulting in lower net income and reduced profit margins. The company is indeed generating positive operating cash flow, as evident from the financial statements. According to page 31, the company's net cash provided by operating activities was a significant $3.1 million for the 3 months ended December 31, 2025. This indicates that the company's operations are generating sufficient cash to meet its financial obligations. Furthermore, page 32 confirms this positive trend with a net change of $4.2 million in provided cash. This substantial increase in operating cash flow suggests that the company is managing its finances effectively and is on track to achieve its financial goals. Overall, these figures demonstrate that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt levels have undergone significant changes over the past year. While long-term debt has increased by $14,281, total liabilities have remained relatively stable. However, a closer look at other areas reveals that total debt has actually decreased from $101,419,000 to $87,099,000. This mixed trend is also reflected in the company's revolving credit facility, which has increased by 25% but still contributes to the overall decrease in total debt. In terms of interest expenses, a significant reduction has been observed. Interest expenses have decreased by $702,000 from 2024 to 2025, and this decline can be attributed to the use of interest rate swaps. This strategic move has helped mitigate the company's interest expenses, resulting in a substantial decrease. Overall, while some areas of debt have increased, others have decreased, leading to a net reduction in total debt and interest expenses. The performance of various segments and regions within the company has been mixed. On a positive note, the UTI segment has shown significant growth, with revenue increasing by 8.6% and new student starts rising by 5.1%. This growth is also reflected in an increase in average full-time active students by 5.7%. The Concord segment has performed even better, with revenue growth of 11.5% and a substantial rise in average full-time active students by 9.5%. However, the corporate segment has struggled, experiencing a net loss that increased from -$6,038 to -$5,975. Operating expenses have also risen significantly, from $1,869 to $3,956. These figures indicate a decline in performance for this segment. Overall, while some segments have shown strong growth, others are facing challenges that need to be addressed. Management is optimistic about the company's future prospects, outlining a clear strategy for growth and expansion. The North Star growth strategy will be key in achieving this goal, with a focus on expanding campus locations through strategic initiatives. This includes launching new programs and campuses over the next several years, as well as executing a growth and diversification strategy through new program launches. The company is also investing heavily in facilities and equipment to support these new offerings, while continuing to prioritize long-term strategy through investments in technology. Management is confident that the company has sufficient liquidity to fund its operations and growth initiatives, including strategic acquisitions, organic growth, real estate purchases, and share repurchases. This commitment to growth and investment will position the company for continued success in the years to come. There is no notable activity to report on acquisitions and divestitures. The company has not engaged in any significant transactions involving the purchase of other businesses or assets, nor have they sold off any major divisions or subsidiaries. This suggests a stable and focused approach to business operations, with no major changes in their portfolio over the period in question. The company's financial strategy is focused on investing in itself rather than distributing profits to shareholders. One of the key aspects of this strategy is the consideration of repurchasing common stock, which would allow the company to retain ownership and potentially increase shareholder value. However, unlike many other companies, it does not pay a cash dividend on its common stock, indicating that it prefers to reinvest earnings in the business rather than distributing them to shareholders through dividends. Concerns have been raised regarding the accumulation of inventory and potential disruptions to supply chains within educational institutions. A notable example of this issue can be seen in the management of student laptops, where an excessive buildup of inventory led to a significant financial expenditure of $2.1 million. This situation highlights the importance of effective inventory management and supply chain optimization to prevent such costly consequences. That concludes the financial summary for Universal Technical Institute, Inc. Feel free to comment below, and I will be happy to answer them when possible.